Welcome back, everyone, to a very special episode of the Automotive Market Minute, in which may or may not take just over a minute. My name is Steven Georgella.
My name is Philip Tributowski.
And I'm James Sivko.
All right, everyone, as I mentioned, a very special episode live from Fountain Forward South, also known as Bogotá, Colombia. Here we go. We're going to talk about our Fountain Forward dealership performance, national inventory, consumer sentiment, incentives, and some extremely uncomfortable truths that you need to know about. Phil, let's jump into some of those numbers.
Take it away, Steven.
I will, Phil. So we have traffic month over month was actually down about 6%. Leads were down just a hair. Appointments about flat. New sales having a little bit of a bounce. And as we mentioned before, when looking at used inventory, when looking at the market demand for used, we really felt like it was just going to keep on trucking along. We really thought like things were going to stay stable, and we're seeing that across the country. Now, we're about a month after the election. We're seeing some good things from the stock market. We're seeing some very interesting data points. And the best part is, I have the strategy director, I have our chief economist in residence, and they are about to blow the roof off, ending the year with this December Automotive Market Minute. Gentlemen, would you please take over?
Inventory, specifically new inventory, new days supply came in at 86.4 days in November. That is now up 13% higher from last year. Overall, 3.13 million units on the lot. That is up 26% against the prior year. 26%.
Whoa.
If we look at used days supply, that came in at 45.5 days. That is now down 18% against last year.
What's driving the new inventory problem, Phil?
Phil, what's driving the new inventory problem?
Stellantis.
Stellanti, if you will.
Millions of Stellanti.
Well, James, why don't you give me the quick little note here, and then I'll jump in and add some color commentary to it, if you will.
Well, we don't know how to pluralize Stellantis, so somebody out there let us know. Are they Stellantums or Stellanti? But I do know that almost half of the light car and truck inventory in the U.S. are Stellantums sitting around the lot.
So a couple of things here. First of all, this is a sneak peek at what could be the future of the Fountain Forward Index. Okay, so this is shout out to Angie, shout out to the analytics department for putting a tremendous amount of work into this. But this is something that's worth thinking about when looking at the inventory. We'll have another slide here, 2 from now. Can you give me a little sneak here to number 8, Phil, real quick?
Yeah.
Okay, something that's very interesting here is I want you to look at those new retail sales, basically starting at about week 38, 39. You're seeing as new retail sales continue to climb. And then if we were to go back here, you're seeing that those new sales are really climbing after week 39 of this year. But then sure enough, if you look at that inventory, you're not seeing it go down. You're seeing it slow, stay about flat, and then it's climbing a little bit. Then you're seeing this. What James is talking about is let's think about the weighted average here. Are the other manufacturers actually doing much better than we thought? But Stellanti, Stellantum, Stellantis, whatever you'd like to call it, is this the boat anchor? Is James out at sea swimming and he has a 15-pound anchor that's pulling him underwater? It's our hypotheses, or maybe it's our opinion, that is in fact what's happening. And what we're trying to do is build this index to really show you here's what the hell is going on, and here's what's really pulling it down. Because when we look at this, the new car manufacturers, they are selling more vehicles. And then a little tidbit that's going to come up here in a minute about the incentives in December, Nostradamus. Incentives in December, Nostradamus. With those going up, also seeing a little bit of a slide, a little bit of a move upwards. Just how much weight are they really pulling everybody else down?
So let's look at consumer sentiment and lightweight vehicle sales. I want to zoom in on specifically the recent months here.
Can we call those the Trump months? The Trump months. We're going to call them those.
Sure.
Carry on.
Of course we can. Now, I'd like to be clear. We do not have the November print just yet, but November, we know, is going to come in swinging. Consumer sentiment neared a 3.5-year high point in November. But if you look at this trend that's been coming in over the last 3 months, consumer sentiment has been grinding higher. So has lightweight vehicle sales. It has been following consumer sentiment as we touched on 3 months ago, and that is the current state of today's market. Looking at new sales, I just wanted to highlight a couple of numbers here. New sales are running 12% above last year, with a clear pickup over the recent weeks and recent months. Year to date, new sales are up 5% higher compared to last year. And if we look at the used market, estimated used sales are up 13% against last year. Down by 2% in the latest week, but year to date, used sales are up 3% higher compared to last year.
One piece I'd like to say about the used sales, rates are still high. Rates continue to be high. If you go and reference last month, James put a wonderful slide together that showed the fact that when the Fed actually cut rates, it was good for dealers from a floor planning standpoint, but actually tough for the consumer. The majority of the time having 3 to 6 year loans on their vehicles. I want to give a reference to a buddy of mine who's a plumber, probably makes about $100,000 a year, has pretty decent credit overall. Goes and wants to buy a used Ram truck for about $31,000, a $5,000 trade-in, $5,000 down, getting rates back between 10 and 16%. Whoa. Now, the fact that used vehicle volume is still staying pretty heavy, pretty steady, and then we have market day supply for used vehicles about 45 days. My question to the dealers out there that are sitting with a 60-day term, what are we doing? And of course, I'm not operating your store by any means, and I'm not judging. What I'm saying is we have to go all in on that process. If the market day supply is at 45 and you're at 60, you are losing money to the market, if you will, and I will. So I'd like you to keep that in consideration. At the 45 days, if you're sitting at 60 or even longer, that is really where you can make a lot of money going into next year. And again, it shows the fact that the market only has so many used vehicles to choose from. And so you might just have to take that 14% note and hope that eventually you can either refi out of it or just pay it off faster. But that's a pretty tough thing for the consumer, in my opinion. James or Phil, I don't know if you want to go to the next slide or if you have any other feedback on that.
I'd like to go to the next slide and show what the manufacturers are doing in the new car market. Now, we've been calling this for months. We've been calling this for months.
I believe that going into the end of Q4, that all of a sudden the factories are going to blow out when it comes down to interest rates, offers, etc. I believe that December is going to be a December to remember. Do I have December to remember patented or trademarked in any way? Absolutely not. But with that said, I can say it might be a December to remember.
December to remember. December to remember. As of November, 0% APR rates increased to about the January level. Now, so far in December, they're at 3-year highs. Less than 3% APR rates. In December, they're at multi-year highs, 2-year highs. The manufacturers have came swinging in December, and it's going to be a December to remember.
Again, we called it months and months and months ago. And after going into October, I believe, Phil, if I'm not mistaken, in October, we were at essentially a couple-year low.
Correct.
When it came down to incentives, or we were close to a couple-year low.
Close.
Okay. We're sitting there, we're looking at, remember, we're seeing those new sales. They're moving up just a little bit. We see that market day supply on new is actually rising. My opinion is that the dealers really want to have good Q4 reporting going into 2025 when they report on Q4. Now we're going gangbusters when it comes down to incentives. We know we have enough inventory. Stellantis now has no CEO essentially, and needs to definitely come swinging. I'm seeing Jeep Grand Cherokees that are in the Summit and Overland trim level getting $7,500 off. Normally, from my observation over the last few years, I'm not seeing high trim levels get whacked like that. And $7,500 on a Jeep Grand Cherokee Summit is a pretty damn good incentive. And so I think that, again, it's nice to see the fact that our observations, James, Phil, myself, it just looked like they're just waiting and waiting and waiting and waiting. And now they see the fact that consumer sentiment is higher, even though banks, and again, James, I'd really like your feedback here. The banks are sitting there and it seems like from the loans that they want to give out, they're like, I see that you guys are saying that, the sentiment is higher, the Fed cut rates, but we're not going to cut our rates. We're going to keep them at the level, or we're even going to raise them. But the factories are like, yeah, even if the banks aren't going to give us a ton of help, we've got to get this inventory off the ground. We've got to have good numbers. My question to you, James, am I on the right track?
It's a tale of two markets. Through the third quarter of last year, the senior loan officer survey, net percentage of banks tightening for autos was several quarters in a row of tightening of lending standards. And credit spreads are wide and or coupons have been historically high. Specifically, banks don't have a reason to lower rates to create assets, whereas the captives and the finance companies of the manufacturers do. So they'll be out there probably through January trying to use finance to clear inventory in the system.
Those are the type of choice of words that I, what did you use the word about the banks tightening? What was it again?
Tightening standards in the auto space.
I
Yes.
cannot wait to be golfing soon and talk about tightening standards, knowing the fact that I have no clue what I'm talking about. That's fantastic, James. Something to keep in mind, Mr. Dealer or Mr. or Mrs. Dealer, is leads are actually up on a KBB and Auto Trader year over year, but they're actually down month over month. So keep this in mind when you're looking at your lead mix year over year. Again, the reduction of parity in the market. So dealers that are doing better are doing much better. Dealers that are doing worse are doing much worse. Okay. Something to keep in mind is looking at your lead mix and why it's up or why it's down. That's extremely important. And then also looking at unique leads are actually up year over year. So keep this in mind. Look at the lead mix itself. Don't just look at leads, look at the lead mix. Let's go to a more granular view. And then looking at the fact of, okay, do you know how much inventory you had last year versus this year, new and used? And then look at the actual lead sources and what is up and what is down, and then make your move. Don't do it at a 10,000 foot view. While that's good to know, make sure you look a little bit more granular to figure out, okay, what is causing me to have less opportunity, which of course is the thing that we're hearing a lot about in the marketplace. In general, leads overall tend to be up year over year, just depending on what sources. So just keep that in mind as new sales, we anticipate will continue to climb. Go ahead.
Get into the weeds a little bit. There's answers that
the devil is in the details. Ants on the page, James. Can you give me a summary here?
Yeah, this is really interesting. We've done some work digging into the big five dealers. The big five have been rewarded recently with some really rich multiples from Wall Street, multiples that remind me of the late 1990s during their initial growth boom and their initial acquisition boom. And this really uncovers kind of an uncomfortable truth here in the industry. And that is the big five are trading at 10.5 times EBITDA or 6 times sales. This is a very tight range. So Wall Street loves these businesses because they've proven to be able to perform much better in down cycles than anyone would imagine. And they've been very consistent, generating multiples on both new and used units. I mean, take a look at this other one here, EV or enterprise value, if you will, per store, $50 million a store. That's very interesting to see those giant numbers. But then when you actually get to part of their business model, and that is, well, what does all that mean when they're trying to buy you? And the answer is that they're not paying 10 times EBITDA. They're paying between 3 and 6 times. They're not paying 0.6 times revenues. They're paying between 15 and 30% of revenues. Maybe part of the reason why the multiples for these companies are so rich is because they have so many targets out there that they're lowballing. So what is useful here from this slide for you if you own a dealership is that first offer coming from these acquirers is a lowball offer. And maybe it's a private equity acquirer that eventually takes you out.
Great intel there, James. One of the things that we talked about in our pre-brief meeting was these dealerships, again, with the reduction of parity. The positive side of this is, and the motivation, Mr. or Mrs. Dealer, your value, if you can get more efficient, especially during today's market, goes up exponentially in comparison to 2 years ago. It was almost like, well, they're all here and they're all moving together. Now it's like, if you have these stores that are hurting a little bit more, now you become that much more efficient. You now know that your value of your store is exponentially higher than it would have been because of the friction in the marketplace. That's really the takeaway I had from James here in the pre-brief is, man, the motivation to get efficient And that doesn't mean cutting things. That means figuring out how to streamline processes, how to have automations, using artificial intelligence, getting the right lead mix at your store. The motivation is higher than ever, if you ask me.
The devil is in the details.
Devil continues to be in the details.
And take a look at recent performance from the Big Five. Very consistent gross margin per unit, very consistent F&I per unit. Of course, we're all aware that the COVID savings resulted in a scramble for new cars and less pricing resistance from consumers back in 2022. But this is over a wide range of outcomes here. I mean, look at where rates are. It doesn't seem to affect them. We kind of can model in our heads where growth was during COVID, doesn't affect them. So it can be done in the car business. Consistent margins can be maintained.
This has been an incredible start to December. The amount of information that's coming in from the month of November and the direction that it's sending us, or telling us to go, telling our dealers to go, is it's kind of like opening Christmas presents, to be honest with you. What a fantastic automotive market minute, if I may say so myself. We've got 5 of us on the call today. On behalf of Sylvester, Arnold, James, Philip, and myself, this is the Automotive Market Minute, and God willing, we will see you in 2025. See ya!